Good morning and welcome everybody to this Monday, February 10th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures relatively flat today to start. We did have the market falling at the end of last week, but it was a strong week, a really strong recovery off of the big drop that we had back on the prior Friday. Of course, you remember the Dow Jones down 500 points, I think maybe down 600 at one point during the day. The S&P taking a pretty big tumble, all of the major indices really getting hit pretty hard, but we rebounded last week. Market gapped up 4 of the 5 days and continued moving higher, threatened to break out. We did see all-time closing high on the S&P 500 and NASDAQ, very close on the Dow. Really just more lagging in terms of mid caps and small caps, with both those groups falling a little bit. But anyway, we're ready to start a new week. I do want to mention before I get started that we do have an event this evening at EarningsBeats. It is a sneak preview to the top 10 stock picks. That is probably our most popular webinar we have quarterly, where the top 10 stock picks, which is set for February 19th. That'll be next Wednesday. That's where I go through and pick the 10 stocks for each of the portfolios. So that's usually a very well-attended and interesting webinar where I can go through a lot of the companies off of the strong earnings chart list that I really like. And let me go ahead and show you. If you go over to EarningsBeats.com and you can see here at the top, this is the sneak preview of the top 10 stock picks. So tonight, 4:30, we will be taking a look at a lot of companies that have already reported earnings. We'll take a look at some companies that will be reporting earnings. Look at some industry groups that are beginning to strengthen. So you might see some of the names coming from some of these industry groups. Not all industry groups perform the same every quarter. For a while, a number of the financial industry groups were beaten down. Now we've got some that have rebounded, even with the 10-year Treasury yield rolling over. So it'll be a really interesting webinar tonight. The one tonight is free to everybody. So literally, if you're an EarningsBeats Digest member, you got room instructions today, this morning with the event. So, I think, well, we'll try to get the link up here for, no, I don't see the room link. We'll have the room link up here somewhere on our homepage later today. So if you want to come into the event and you're not already an EarningsBeats Digest member and you didn't get the room link this morning, we'll make sure we put it here on the website. The only thing we ask is if you do come in and you're not an EarningsBeats.com Digest member, we'll add you to the free newsletter. So no credit card, nothing. Comes out Monday, Wednesday, Friday, as you can see. Really a lot of good information dealing with earnings and relative strength. We just want to make sure that our community members are educated about those two topics in particular, especially when it comes to holding into earnings reports and so forth. But anyway, we do have this event later today starting at 4:30. Just wanted to make sure everybody's aware of it. So looking at the charts from Friday, I mentioned, last week was a good week. We did come down on Friday. You can see the Dow was down almost 300 points, the S&P down 18, the NASDAQ down 52. Mid caps on a percentage basis, you can see mid caps down 1%, small caps down almost 1.5%. So again, relative weakness in those two areas. It looked like we were starting to show some nice relative strength in both mid and small cap stocks last week during the rally, and then gave it right back on Thursday and Friday. So not great action there. In terms of individual sectors, normally when you see a sell-off like we had on Friday, we're going to be led by defensive areas. And that's what we saw on Friday. Staples and real estate, the only two sectors to actually finish in positive territory. Do want to mention Staples did make a closing breakout on Friday. It wasn't by much, but it was a new closing high breakout on the XLP. Other areas that did not perform so well: materials down 1.43%, technology down almost 1%, and healthcare down about 0.75%. 10-year Treasury yield. Let's look at this. This is a 5-year chart on the TNX. And as we have just dropped very, very rapidly here over the, here in 2020, you can see we were up near 195 or so at the end of 2019. And now here we are at 1.56. That's been a pretty big drop in yields. Normally, I would say that would be associated with the market saying, hey, we got problems with growth. I don't think it has anything to do with growth. I think it has everything to do with low inflation. And the bond market, I believe, is screaming to the Fed to cut rates again. And I know that might seem counterintuitive to a lot of folks, but what we have right now is growth without inflation. And you don't see that very often. I can't remember any time in my lifetime that we've had growth, and the natural reaction in the bond market normally is to sell and move into the stock market. Well, when you sell bonds, yields go higher. So Treasury prices go down, yields go up. And so when we went through the fourth quarter, that's exactly what was happening. You see the yields were moving up. That means a lot of money rotating out of Treasuries. All that money was rotating into equities. And now I think what's going on is the market saying, wait a minute, we've gotten a number of reports. We just had the GDP report out a week ago Friday that said the PCE index was only rising, I think it was 1.3% or 1.4%. And the Fed's target rate for inflation is 2%. So that was coming in way below expectations. And then on Friday, when we got the jobs report, really good jobs report. We actually had a good one on Wednesday with the ADP employment report. And then we got another one on Friday with non-farm payrolls. And yet the average hourly wages, average hourly earnings rose 0.2%. The market was expecting 0.3%. So we're getting strong jobs reports, but we're not seeing the inflation components. We're not seeing it in terms of prices. We're not seeing it in terms of wages. And so the bond market, in my opinion, is just telling the Fed, let's go, time to lower rates. There's no threat when you've got no inflation. And to be honest, they should be trying to inflate the market. And the way to inflate the market is to see a drop in the dollar and a rise in commodity prices. Well, in order to see a drop in the dollar, you need to lower interest rates. We need to lower our rates here in the US in order for our currency to drop versus other currencies. So I think the bond market is really screaming to the Fed that we need another rate cut. It's starting to be priced in now mid-year. I'd be surprised if we don't get it before then, especially if we see no additional signs of inflation and we continue to get reports that are disinflationary. That to me would suggest that the Fed probably will cut rates again sooner rather than later. And what that means for the stock market is we've got growth. We've got both jobs growth. We've got income growth. We got growth without inflation. And if you get growth with lower interest rates, those earnings of those companies that are experiencing the growth, the earnings become extremely valuable. They just continue to get more and more and more valuable. And anybody who questions why I believe the S&P 500 goes to 4,000 this year just needs to understand that the earnings, the value of those earnings, those future earnings, grow immeasurably almost when you're in a period of cutting interest rates and you're already near historic lows to begin with. So we got a lot going on with the bond market to watch, but as long as the bond market keeps going down like this and threatens these lows that we saw in the last 5 years, I believe this is going to be an opportunity for the stock market to continue its unabated, almost unabated advance higher. All right, I'm going to move into some earnings reports. Just a couple out this morning, a couple more will be out later. Let's take a look first at AGN. This is Allergen. They did beat on their top line, $4.35 billion versus $4.09 billion. Bottom line, $522 versus $461. And when you look at it, it's actually been a pretty good performer relative to the pharmas. Pharmas did reach about a 6-7 month relative high a few weeks ago versus the S&P 500. But I would say for the most part, the last several months has been relatively flat. So it's not been a bad group, but it's not been a leading group either. But this has been one of the better performers and came out with a pretty nice report. The stock was up fractionally. This morning, I saw up about 0.25%. So we're talking about maybe 40 cents, something like that, 40, 50 cents. But it is in breakout territory. AGN still looks pretty good to me. In the restaurant space, we've got QSR, which is Restaurant Brands International. This one's been in a downtrend for quite a while. And you can see, even though restaurants have been uptrending the last few months, when you go down here relative to the S&P 500, it really is not making up much ground. In fact, it's down near a 52-week relative low. So restaurants, which had been soaring on a relative basis as late as August of last year, have really come crashing back down on a relative basis, even though you don't see it on the absolute chart. The absolute chart's been rising, so prices have been going up. But this is a group where, for the most part, you really just want to be in the best stocks in the space. So I would say something like Chipotle makes sense. I would be careful with a lot of these stocks, especially individual stocks like QSR that have been downtrending. But having said all that, maybe we're getting a character change. We have gone up the last 4 days last week. QSR beat on their top line, $1.48 billion versus $1.46 billion. Beat on their bottom line, 75 cents versus 73 cents. And then this morning, I'm showing in pre-market action the stock up about 4%, which would be probably $2, $2.50, maybe close to $3. That looks like it could take out the high established just a couple of weeks ago, 2 or 3 weeks ago. So maybe this downtrend is ending on QSR. It's not just where it opens, but also how it finishes today. You know, is it going to continue that rally so we get a gap up and then it continues to move higher? When you get the gap up, everybody wants to buy. You got market makers on the other side of the trade that are on the short side. So when a stock gaps up and it keeps going higher, that's generally a sign of pretty good demand. When it gaps up and starts coming back down, that's when you got to be a little bit more concerned about whether the rally will stick and, you know, what the future might hold after that. But I love gap ups with earnings that beat on top and bottom line. I love to see those gap ups, and then with a continuation to the upside, a long hollow candle. Those tend to be very bullish candles. All right, some other earnings that'll be coming up after the bell today. Mercado Libre, MELI. This is a stock on a relative basis that just set a 52-week high last week before printing that bearish engulfing candle and coming back down the last 3 days of the week. So the stock was up over 725 on Wednesday at the open, and by Friday's close, it was back down to 646. I would say this one's priced for a pretty good report. We'll see whether or not we get it later today. All right, RNG, this is Ring Central. Another stock setting 52-week high just a couple weeks ago. The group is broken out, computer services. This is a strong group and a strong stock. Now, when I say strong group, it's a group that really has it started to pick up the beginning of the year and really accelerated over the last week or two, thanks in large part to IBM. So IBM a couple weeks ago came out with their earnings, but last week and a half, IBM has had a tremendous advance after announcing that their CEO was being replaced by the guy that was in charge of their cloud computing. I don't remember his name offhand, but he was in charge of their cloud computing area. He was named CEO, and the stock, you know, there's nothing like a farewell gift when you've been the CEO for a company and you know, there's an announcement that you're going to be replaced and the stock absolutely takes off. That's not a good sign of what Wall Street was thinking about your management capabilities. But anyhow, IBM has really tacked on a lot here in recent days. And as a result, computer services are now starting to get a little bit of attention on Wall Street. And RNG, as you can see, look at the volume trends here. And look at that candle right there. That's what I was talking about earlier. When you get an earnings report on this kind of volume, when it gaps up and you know market makers are on the short side and they cannot get control of the stock, it hardly moved down at all from the open. That just tells me, it's kind of paints a picture that you've got a lot of folks, a lot of people trying to accumulate the stock as soon as the opening bell rings. And when you get that move up, then instead of looking to fill the gap down at the bottom, a lot of times if you just get back down to the top of the gap, we almost got there, didn't quite, But if you get to the top of the gap, a lot of times that's where I'd be looking for a reversal. The other thing that I'd like to mention here on RNG, and I've been talking about this a lot, is that when you get a gap up, that is roughly the highest point of any candle body. Looks like this is the highest candle body back in August. So that would have been August 27th. Whatever that open was, I look to see when you get a big earnings report like this, do you open above or below? And if you open above, a lot of times that gives me a much, much more bullish feeling on a stock when you've got a gap up, when you've got a candle body that opens above any prior high candle body. That just tells me market makers, based on the demand, are deciding that the stock should be in breakout mode. And they were, like I said, they weren't much resistance after the open, big move up. So this is the kind of candle that I really, really like. Now, does it mean that we should jump right in after the candle? No, but I put these on my watch list, and this is how I would annotate. If I was to annotate this chart, that is the line. To me, that's the biggest support line on the chart until it's proven otherwise. So when you get a stock that gets up to about 178 and it pulls all the way back to 148, 149 within just a few dollars of support, that's the time really to think about getting in, because your reward to risk is much better at this level than it is back here at this level. So anyway, RNG reports after the bell today. I don't know if we'll get that kind of candle again, but the stock is definitely trading up. I think Wall Street's expecting a big report. We'll see what happens. Next up, STE. This is Steris. This is in the medical equipment area. Nice looking absolute chart. I see a move up, pull back, another move up, higher lows. So I see equal highs, higher lows, nice ascending triangle. We'll see if we get the breakout. Again, what I would look for after the bell and tomorrow's open would be an open above 155.34. So that is the highest candle body on this chart. No other candle bodies. And when I'm talking about the candle body, I'm talking about the rectangle. These tails are outside the body. All right. Let's look at XPO Logistics. Transportation services starting to show a lot more strength. Here's the group breaking out. Here's the group breaking out to an absolute high in January, but also breaking out to a relative high versus the S&P 500. So the group definitely has been strengthening, but while XPO has been consolidating, you can see that the group overall has been pulling back versus the transportation services group. But even with XPO consolidating, it's actually going down less than the overall market, or less than the overall industry group. So I think Wall Street's looking for a big report here with XPO. We'll see what happens after the close today. How about JCOM? All right, this is J2 Global Communications in the internet area. This was one that was kind of surprising to me. Hold on one second. All right, this was kind of surprising to me because when the internet group broke out, this was one of my favorite stocks in the space. It had broken out, had reported some strong numbers. On a relative basis, you can see right here back at the beginning of November, had broken to a new 52-week high relative to the group. And just as that was happening, the group was breaking out right here in November into early December. So I really thought JCOM was going to, make a big push, and internets did. And JCOM went up, but look at the relative strength. Relative strength actually now for the last 3 months has been coming back down. So this one's going to be a real interesting report. I think you got a great area of the market, internets, but I'm not so sure why this stock has been going down for 3 months. I mean, it hasn't been consolidating. We actually got a breakout here on an absolute basis, but the relative strength really didn't pick up, even with a breakout. So I don't know what to think of JCOM. This one, like I said, is going to be really interesting as we go into its earnings report later today. Let's take a look at a software stock, Rapid7. Now, we know what software has been doing. Software has been going straight up, and on a relative basis, it's absolutely been on fire. I would say it's one of the best, if not the best, area of the market, right up there with Apple and computer hardware. But RPD on a relative basis topped versus software all the way back in July at this high. And since then, it's been moving lower. And in fact, over the last month on this relative drop, it's not too far from its 52-week relative low. So I'm always a little tentative when I've got a really strong industry group, but a stock that's not really keeping pace with the industry group. It's been rising, but for whatever reason, Wall Street likes other software companies better. And they're the ones who go out and meet with these companies, meet with management. So I'm a little concerned. I certainly wouldn't short it. I wouldn't short anything in the software space. But it's one that I need to see that character change. I need to see the relative strength really jump. And with this type of company, it certainly could happen. Maybe they're just not delivering the goods to the analysts on Wall Street. Maybe they're keeping them, keeping things, on the lowdown to themselves. Who knows? But another one that'll be interesting to watch. A company that will be reporting after the bell today that's in one of our portfolios is AMKR. And this one, this was a huge candle with massive volume. And this one, that top of gap support did not work. And the stock just recently made its way all the way back down to fill this gap just in time for its next earnings report. I've seen this before, and I wouldn't be surprised to see a big gap up on the stock. Frustrating all those who've been trying to trade it for the last 3 months. When I look at it on a relative basis, it's kind of back where it was before the earnings report, actually maybe even a little bit below. But like RPD, Rapid7, it's in a very strong group. It's in the semiconductors group, which has been going up. We've seen a lot of semiconductors beating expectations. This one is sitting almost right at gap support. That open was 1108. Yep, it's right on 1108 where it closed. And now it's just in time for its next earnings. This one's going to be a tough call too. I could see it going either way, but I would not be surprised if it comes in better than expected. Next up, I think another company in our portfolios that has not been performing well in the software space, Digital Turbine, I believe, reports after the bell today as well. Another one that's been going down. Both these stocks have been holding back the aggressive portfolio. Maybe they'll give them a lift after the bell today. But this is one that just a couple months ago, very, very strong relative performers, been now downtrending. It is at a major gap, or not gap support, but price support level. So right there, you can see the big pullback here. Got close again in early September, tested it in late September, tested it again in October. And here over the last couple of days, we've been down near that $6 level, maybe just a tad below, got to $5.95 on Friday. So both of these, AMKR and APPS, APPS, the volume trends are a little bit more worrisome to me than on AMKR. So if I just take a look at this, you can see most of these down days are accompanied by pretty heavy volume. That can be a pretty bad signal. I mean, that could be distribution taking place. If you look at AMKR, we don't see that at all. On this move down, you can see the volumes picked up a little bit here in the last 2 weeks maybe, but a lot of this other selling right in here was on much lighter volume, and actually the big volume came on up days. I would give, again, this is just purely an educational guess, but these two companies, I would give AMKR the edge based on the way they've been trading. I think there could be a lot of willing buyers of these shares where the volume's picked up a little bit in the last few weeks. We'll see. I mean, that was a big move from 1108 to 15 in a day. Sometimes it takes a while for a stock to absorb that type of a move higher. I wouldn't be surprised to see AMKR, along with many of the other semiconductors, coming out with better than expected news. We'll see. Anyway, went through a lot of earnings reports. You want to talk about more earnings, you want to hear more and look at more charts, join me at 4:30 today. I'm sure we'll be looking at tons of charts and earnings, both upcoming and companies that have released. And we'll be talking about some that are releasing after the bell today as well. Anyhow, let's keep moving. I did want to mention just quickly that FFIV was upgraded this morning. This is F5 Network. Stock's been moving down for a while. It is at major support, maybe a short-term upgrade. I don't know about this one. I need to see a lot more. This is a really poor stock in a very poor group. So one of the worst industry groups and one of the worst stocks in the industry group. So I don't know about that upgrade. FDX, FedEx, starting to show a little bit. Nice Friday, but the overall downtrend continues. Relative weakness in the group. The stock is picked up, but it's picking up against a very, very poor group. As you can see, the big breakdown. I mean, the group on an absolute basis is almost near its 52-week low. So not really liking that one. Lyft got an upgrade today, so maybe that'll get a lift later in today's action. But Uber has been on fire, I think. So Lyft's been going up in sympathy. Lyft reports this week. Downgrades, CBOE got downgraded. Stock broke out last week. That was a nice breakout. Pullback, I think the 20-day moving average actually, in my experience, when you get these breakouts, I used to get whipsawed because I would like to see this price support hold, and it didn't, just like it didn't on Friday, and then I'd get whipsawed out. So I'd buy the breakout and I'd sell when it failed to hold the breakout. As I've watched more and more stocks, I've seen that happen more and come down to the 20-day and then reverse. So watch CBOE today on this 20-day test if we get it with the downgrade. Also want to mention a couple of semiconductors were initiated by Wells Fargo with overweights, Qorvo, KRVO, and Skyworks, SWKS, both stocks that I like. Let's just take a quick look at a few industry groups a couple of industry groups before we get into the three you must see. First thing I want to do is just show you broadline retail. Broadline retail has now made this breakout. I'm going to go back. Let's go back 3 years so you can see the absolute breakout here. See the equal highs and the rising lows? That's an ascending triangle. We have broken out. The biggest component here is Amazon. I like Amazon. I also like Target, which gotten beat up a little bit for a while, but I think Target will likely rebound, especially if money continues to rotate in. So that's one group I wanted to highlight. I wanted to also highlight the soft drinks. When you look at this over the last 3 years, first of all, you get in these periods where you go sideways for a while, but when you make the breakout, you can get a big run. Here was sideways. We recently broke out maybe about 3 or 4 weeks ago. This group continues to go higher. I think soft drinks look good. Coca-Cola, Monster, a couple favorites there. Personal products. You can see just made another breakout after coming back down, testing that 50-day moving average, turning back higher. So personal products group, I think, looks pretty good. And then one other one, I think it's coming back again, and it may make the breakout. Watch 2200 on the biotechs. It looked like they had fallen apart at the end of January, and look how quickly they come roaring right back. This is a group that when it breaks out, it's like semiconductors or like the software group's been. When it breaks, it can run, and it can run for a long time. You don't really see that much here on the 5-year chart or 3-year chart. But let me go back 7 years and take a look at the run that this group had in 2013, 14, and 15. 900 to 2200 in about 2.5 years. So all this sideways consolidation, we get the breakout. This is a group you really want to be watching in 2020. I think this one could be a big leader. All right, 3 you must see. I'm running out of time, so I'll go through these pretty quick. First one is CBIO. This is a stock that made a big move back in December, consolidated, and then on Friday broke out again. I do want to just mention on a longer term chart, you can see this is a stock that has its moments and then goes right back down again. So for me, it's more of a trade, but 2017 into 2018, this stock ran from 3 to about 35 in 5 or 6 months. So with this volume starting to come back in, similar to what we saw back here, I don't know if it's going to do that, but at least maybe it should be on your radar. It is in the biotech, or no, I think this one's pharma. Yeah, it's in the pharma space. But pharma, like the biotech, has been performing really well. So anyhow, I wanted to mention this one. TMUS, T-Mobile. T-Mobile makes the breakout above the July high on Friday. The volume expands. Wireless still trying to make the breakout, but T-Mobile relative to its peers really expanding. I think this one looks good. And then finally, SKX. This is Skechers. gapped up. It had really good revenues last week. I think 1.33 billion versus 1.25. Their earnings per share came in at equal. I think it matched 17 cents from what I recall. Stock gapped up, tried to go up here and test the high and then reversed back down. Doesn't look particularly enticing, and it wasn't an earnings beat, so it's not going to be on our list. But I do want to just mention that Skechers, on a seasonality basis, if we go back the last 20 years, February goes up 75% of the time. It averages going up 5.6 in February, 4% in March, and 10.3% in April. So February, March, and April, Skechers averages going up 20% during this three-month period over the last 20 years. So when you look at the chart and you see the chart threatening a breakout like this, I just want to point it out. This is the time of the year when Skechers tends to do really well. All right, that's it for today. Again, thanks for tuning in. I'll be back later this afternoon for our webinar at 4:30. That'll be a sneak preview of my top 10 stock picks. Love to have you. And again, it's a free webinar. Go to EarningsBeats.com. Later today, we will have a link directly into the room, and you can come join us. But again, if you do come in, I ask that you allow me to add you to our free newsletter if you're not already a member of the free newsletter. And we've gotten a lot of really good response to the newsletter. And like I said, it's free, no credit card. But that's, maybe the payment for the webinar is just join our community. All right, that's it. Everybody have a great day. Be back tomorrow over at Stock Charts TV. Happy trading.